If you sell a gold Britannia coin for a £5,000 profit, you owe HMRC exactly nothing in capital gains tax. Hold that same coin in a safe until you die, and HMRC can take 40% of its value in inheritance tax. Same coin, same owner, two very different bills. That gap is the thing almost nobody explains. Most guides about tax-free assets are built to help you dodge capital gains tax, which now runs at 18% or 24% depending on your income band. They stop there. They never mention the £325,000 inheritance tax threshold sitting behind it, or the fact that some so-called tax-free assets can quietly leak 50% of their value in storage fees, insurance and selling costs before you ever see the money. So you can win the small argument and lose the big one. A £4,000 capital gain saving looks clever right up until it is sitting inside a £28,000 inheritance tax bill. I have watched people do this without realizing. They read one article about gold coins, move a chunk of savings across, feel pleased with themselves, and never check what happens to that money at the other end. Today we are not just listing the 6 assets HMRC will not tax for capital gains. We are stress testing every one of them against the total tax reality for a British retiree in 2026. Capital gains, inheritance tax, means tested benefits and the cost of actually getting your money back out again. Some of these 6 hold up beautifully. One of them is not really an asset at all. It is a threshold, and crossing it without knowing is what catches most people. If you are somewhere between 55 and 65, trying to protect a nest egg you spent 40 years building from being hollowed out by rules that overlap each other, subscribe to Arthur's UK Retirement Guide. This is the sort of thing we work through properly. Let us start with the one everybody thinks they already understand. Here is the line that decides everything. Gold sovereigns and gold Britannias are British legal tender. Because they count as currency under the Coinage Act 1971, selling them creates no capital gains tax, no matter how large the profit. Buy a Krugerrand instead, or a 1 kilo gold bar, and you are fully inside the capital gains net. Same metal, same purity, near enough. The only difference is whether the Royal Mint stamped a face value on it. That single detail is worth real money. Say you put £50,000 into sovereigns and they grow to £70,000. That is a £20,000 gain. Take off the £3,000 annual exempt amount and you have £17,000 taxable. At the 24% higher rate, that is £4,080 you simply do not pay. On Krugerrands, you would. So far so good. Now the part the dealers do not put in the brochure. Gold is exempt from capital gains tax. It is not exempt from inheritance tax. For inheritance purposes, those coins are just another asset in your estate, valued at whatever they are worth on the day you die. If your estate is already above the £325,000 nil rate band, that £70,000 of gold is taxed at 40%. That is £28,000 gone. Put the two numbers side by side. You saved £4,080 in capital gains tax and handed over £28,000 in inheritance tax. Nobody sets out to make that trade. People make it by accident, because they solved the tax they had heard of and never looked at the one standing behind it. Why does it happen so often? Because capital gains tax is a tax you feel. You sell, you fill in a form, you write a check. Inheritance tax is a tax somebody else feels, years later when you are not there to see it. The pain is deferred, so the planning gets deferred with it. There is a second sting, and it catches people at the other end of the wealth scale entirely. I used to think gold was the ultimate off-grid retirement asset. Then I watched what happens when someone on pension credit forgets that the DWP counts capital, not just income. Your first £10,000 of capital is ignored. Above that, for every £500 you hold, the DWP treats you as having an extra £1 a week of income you never actually receive. Put £30,000 of sovereigns in the loft, and that is £40 a week of assumed income landing on your claim. It can shrink a pension credit award badly, and pension credit is the gateway to help with council tax, NHS costs and the winter fuel payment. Gold does not hide the way people imagine. Purchase records exist, Insurance schedules exist, and the DWP and HMRC share far more data than they did 5 years ago. There is a quieter cost as well, and it is the one that eats the return. You buy sovereigns above the spot gold price, and you sell them below it. That spread is often 3% to 6% each way. On a 5-year hold, that is a real slice of your gain gone before tax ever enters the conversation. Gold is easy to buy and awkward to sell well. Which brings me to an asset HMRC treats as though it is slowly disappearing. Because it genuinely is. HMRC has a rule that sounds almost generous. If an asset has a predictable life of 50 years or less, it counts as a wasting asset, and gains on it are exempt from capital gains tax, however large the profit. A cask of maturing whisky qualifies, because whisky evaporates. The trade calls it the angel share, roughly 2% of the cask every year. Something physically shrinking cannot have a predictable life beyond 50 years, so HMRC lets the gain go untaxed. Take David, 62, who put £15,000 into a cask because a salesman told him it was a tax-free slam dunk. Let us run his actual numbers rather than the brochure ones. The cask grows about 10% a year. After 5 years, the paper value is around £24,000. Now take the friction off. Bonded warehouse storage and insurance run near 1% a year. The broker takes an exit fee of around 15% when the cask is finally sold. Strip those out, and David clears roughly £19,500. That works out near 5% a year, and he carried single asset risk the whole way. A dull stocks and shares ISA would have done as well or better, with no exit fee and nobody to chase. There is also a catch nobody mentions at the point of sale. The exemption is not automatic. Where a whisky is genuinely fine and collectible, HMRC can argue it is not a wasting asset at all, because casks of that quality are routinely held well beyond 50 years. Bottle the cask yourself, and the exemption falls away completely, because a sealed bottle does not evaporate. David could do everything he was told and still receive a letter. That is the trade-off nobody prices in. You accept an asset you cannot value, cannot sell quickly, and cannot easily verify, in exchange for a tax saving that might not survive a closer look. So I use a simple filter. Call it the liquidity test. If you cannot turn the asset into cash within 7 days, at within about 1% of its stated market value, it is a high-friction asset. Not a bad asset necessarily. But it has to earn a materially higher return to justify the friction, and it should never be the money you are relying on for the years between finishing work and your state pension arriving. Vintage watches and classic cars sit in the same bucket. A car is a wasting asset in HMRC's eyes, and the gain is exempt. Try selling one in a fortnight because the boiler has died, and you will find out exactly what a quick sale discount looks like. Whisky evaporates. Your home is supposed to be the one thing that does not. Except a lot of people over 55 have quietly changed what their home is used for, and HMRC has noticed. Private residence relief is the biggest tax break most British families will ever use. Sell your only home and the gain is exempt from capital gains tax. That is why people say a house is tax-free. It usually is. Usually is doing a great deal of work in that sentence. Picture the common version. You have lived in the house for 20 years. For the last 3, you have used the back bedroom and the old dining room as a consulting office, or you have let them out on a short let listing. Call it 25% of the floor space, used exclusively for business. You sell, and the gain since you bought is £200,000. HMRC can look at that exclusive business use and remove private residence relief from that slice. On those numbers, 3 years out of 23 on a quarter of the house, that is roughly £6,500 of gain exposed. At 24%, you are looking at about £1,560. Not ruinous, just a bill nobody had budgeted for, arriving in the same month as the removal van. The word doing the damage is exclusively. A desk in the corner of a room you also sleep in does not cost you the relief. A room with a lock on the door, listed as business premises and put through the accounts, might. Then there is the other end of it. When you die, your home can carry an extra inheritance tax allowance, the residence nil rate band, worth £175,000, on top of the £325,000. Stack a couple's allowances together and £1 million can pass with no inheritance tax at all. That is the headline everybody remembers. What they do not remember is the rest of it. The residence nil rate band tapers away once the estate goes above £2 million, losing £1 for every £2 over that line. It also only applies where the home passes to children, stepchildren or grandchildren. Leave it to a sibling or a niece and it does not apply at all. So the honest trade-off looks like this. Downsize now and you turn an illiquid asset into cash you can shelter and actually spend, but you give up part of that residence allowance and you pay stamp duty and moving costs for the privilege. Hold on, and you keep the allowance, but your money stays locked inside bricks during the exact years you may need it most. There is no clean answer here. There is only knowing which one you are choosing, instead of drifting into it. Your home is your biggest asset, but the most useful tax-free tool for someone at 60 is not the house. It is a wrapper that is about to change, and the change lands on the 6th of April 2027. An ISA is not an asset, it is a wrapper you put assets inside. Everything that happens in there is invisible to HMRC. No capital gains tax on the growth, no income tax on the interest or dividends, nothing to declare on a tax return at all. For 2026 the allowance is £20,000 a year. That is the cleanest tax break in the British system, and it is the one being trimmed. From the 6th of April 2027, the amount you can put into a cash ISA falls to £12,000 a year if you are under 65. If you are 65 or over, you keep the full £20,000 in cash. The overall £20,000 ISA allowance does not change, and stocks and shares ISAs are untouched. The intention is to push more money into investments and less of it into deposit accounts. Look at what that means for one specific person. If you are 58 now, you have this tax year at the full £20,000 in cash, then an £8,000 a year reduction every year until you turn 65. Across those years, that is tens of thousands of pounds of shelter you will never get back, because ISA allowances do not roll forward. Miss a year and it is gone permanently. Now put that next to the timing problem people your age are actually living with. The state pension age started moving from 66 to 67 on the 6th of April 2026, phased in through to 2028. If you were born on or after the 6th of March 1961, you are waiting until 67. The full new state pension is £241.30 a week, about £12,547 a year, and it does not arrive a day earlier because you stopped working. So the gap between the day the salary stops and the day the state pension starts has got longer for a lot of people. That gap has to be funded by something liquid, something you can draw on without triggering a tax charge, and something that does not push you over the £12,570 personal allowance. A cash ISA does all three. That is precisely the tool being narrowed. I am helping my brother-in-law with exactly this at the moment. He has money sitting in an ordinary savings account, earning interest he is taxed on, for no reason beyond inertia. Moving it into the wrapper before the rules tighten costs him nothing except an afternoon of paperwork and one phone call. None of this is a reason to panic. It is a reason to use the allowance while you still have it, rather than working out what it was for in 2028. ISAs handle growth and flexibility well. But if what you want is a fixed sum arriving on a date you already know, with the gain outside capital gains tax entirely, there is an older and far duller instrument that does the job better. Gilts are loans to the British government. HMRC exempts them from capital gains tax completely. Not a relief, not an allowance, an outright exemption on the capital gain, however large that gain turns out to be. That matters more than it sounds because of how a gilt is built. A gilt pays a fixed coupon, then repays exactly £100 per unit on a fixed date. When interest rates rose, older gilts carrying tiny coupons became unattractive, so their market price fell well below £100. The coupon is taxable as income. The climb from that discounted price back up to £100 at maturity is a capital gain, and that part is tax-free. Run the small version. You buy a gilt at £90 that matures at £100 in 2 years. That £10 is yours, untaxed, whatever your income tax band. Do the same trade with a corporate bond, and the gain sits inside the capital gains net at 18% or 24%. Same shape of trade, different tax outcome, purely because of who did the borrowing. The lower the coupon, the more of your return arrives as tax-free capital, and the less arrives as taxable interest. A gilt with a 0.25% coupon throws off almost no taxable income at all. For someone whose state pension already uses up nearly the whole £12,570 personal allowance, that distinction is worth real money every single year. The practical move is straightforward. Work out which years you actually need money, then buy gilts that mature in those years. If you finish work at 62 and your state pension starts at 67, you have 5 years to bridge. Buy something maturing in each of those years, and you have built a ladder that pays a known amount on a known date, with the growth outside capital gains tax and very little taxable interest along the way. You are not guessing at markets, you are matching a date to a bill. That is a very different exercise from investing, and it is a great deal easier to sleep through. 2 honest caveats before we move on. Sell a gilt before maturity and you take the market price, which can sit below what you paid, and the exemption covers capital gains tax only, not inheritance tax. Gilts sit in your estate like everything else you own. That is 5 of the 6. The last one is not something you buy at all. It is a line you must not cross without knowing it is there. The 6th item is not an asset. It is a threshold, and it sits at £6,000. Personal possessions are called chattels by HMRC. Sell one for £6,000 or less, and any gain on it is exempt from capital gains tax. A painting, a watch, a piece of jewellery, an antique clock. Under £6,000 walk away, nothing to report. The catch is the word set. If you sell a collection of watches, a matched pair of vases, or a run of first editions by the same author, HMRC can treat that set as one asset. Selling them individually to 6 different buyers over 6 months does not help you. The test is what the items are, not how you arrange the invoices. So 4 watches at £2,500 each feel like 4 exempt sales. If they form a set, that is a single £10,000 disposal, and the gain above the £6,000 line comes into the tax net. Now the part that makes people uneasy. Online selling platforms have to report sellers to HMRC once they pass either 30 sales in a calendar year or roughly £1,700 in receipts. That reporting is automatic. It happens whether you owe anything or not, and nobody asks your permission. It feels like being watched, and I understand the reaction completely. But being reported is not the same as owing tax. Most people clearing out a loft are selling personal items for less than they paid, and a loss on a personal possession is not taxable and not reportable. There is also a separate £1,000 trading allowance for genuine small-scale selling. The problem is not really the rule, it is that the burden of proof has quietly moved onto you. HMRC sees a number arrive. You are the one who has to explain what it was, which brings me to the smallest useful change in this entire video. Keep a folder. Photograph the receipt, or the auction listing, or the valuation, whenever you buy something worth having. 1 folder, 1 photo, 30 seconds. When a letter turns up 3 years later, you have an answer instead of an argument. We have been through all 6. So which one actually wins once you run the total tax test? All of it comes down to one line. Do not let a 24% capital gains saving walk you into a 40% inheritance tax bill or a 50% leak in fees and forced sale discounts. Gilts and ISAs came out best because the tax break is certain, and you can get your money out on a date you choose. Gold and whisky came out worst, not because the exemption is fake, but because everything sitting around it costs you. None of these 6 is right or wrong on its own. It depends on the size of your estate, your retirement date, and whether you will need that money at 63 or leave it behind at 83. If you want to go deeper on the inheritance tax side of this, subscribe and stay with me for the next one. Retirement is not about what you make, it is about what you keep. Stay savvy.